Welcome back, traders. Let's go ahead and watch another ICT 2025 lecture today. Now, looking at his YouTube page, he started doing this new storyteller series. Now, I don't know what the difference is between that and the lectures he's been doing, but I'll go ahead and check it out as well. And if I can do like a similar style video where I interject with my own commentary, I will do that, but I'll put it all in a separate playlist. Now, if I do those videos, I will be going in chronological order until I can catch up to the most recent video. This one for today is going to be a short 8-minute NQ review on May 29th. But before we get started, I just want to say thank you to all my subscribers. You know, because of all of your support, I'm able to go over 600 subscribers. When I first started this channel, I was actually unsure if I was even going to go over 100, but here we are at 600. And you know what? I'm super thrilled. You guys are so supportive. You make me feel like I can even go above 1,000 someday. But anyways, I just want to say thank you. Thank you so much. But yeah, that's it. Let's go ahead and get started with the lecture.
This is a weekly chart of the continuous contract for NASDAQ. And you can find that on TradingView with the symbol NQ1! And it's important to use that when you're using higher time frame charts because it's a better way of showing continuity in price delivery, because the front month or nearby contracts are always spotty when you look back in a higher time frame. Even if you change it to a monthly or weekly chart, you're not getting the true perspective. So a continuous chart is helpful in that regard. So this wick here, I did an analysis on about a month ago, and you can look at it again on all the content I posted on X and on this YouTube channel. I said this wick here, while we were below it down here, we would gravitate up into it, and I was looking at the lower half of it. So this line here, the 22,103 level, that's the consequent encroachment or midpoint of this wick. So I'm only interested in this half and grading that in quadrants. So what we do here in this area is salient to what we'll do in the next month or 5 or 6 weeks. Ultimately, it's likely to see these highs get taken out because I'm not trying to pick a top. So the market has been shunning the traditional bearish seasonal tendency. So when it does that type of thing, it's usually very bullish. So I want to keep my focus in the lower half of this wick before I marry the idea that it's absolutely going to go above here. Okay, so while I'm submitting to the idea that order flow is bullish, it's likely to go up there, but I'm not hardlining that it's going there. I want to see how it delivers inside the lower half of this wick, which is why I have all the gradient levels here. Okay, so if we take our attention down from this in the weekly chart, inside this area here, we'll look at the daily chart and see the fair value gap I was mentioning this week and a couple weeks ago. You take a look at the daily chart here. This is the fair value gap. So this candlestick's high, this candlestick's low, and it's a SIBI. So we have this inefficiency, and I have gradient levels in it. So it's the upper quadrant, consequent encroachment in green, lower quadrant, and then the low and high is obviously shown by the rectangle being applied. So if we go back and look at what we were doing when price was trading in here, my commentary was suggesting that this low, I wanted to see it continue, obviously, but if it were to drop below that low, I wanted to see it act as institutional order flow entry drill, which is just simply a partial entry into an imbalance. Okay, so we had to actually deliver. That's probably random. And then the market trades higher, comes right back down into immediate rebalance. This candlestick's high, and I'll annotate that for you here. Now, I could get carried away here and make this video very, very long, but that's not my interest. But the immediate rebalance here, and then sends it higher up into the lower quadrant of that daily fair value gap. So that for me satisfies my weekly objective. I'm certainly content with that. Everything delivered as I was expecting. Everything I gave guidance for on X this week has been just perfectly delivered. So it's really hard to be upset when the market does that. So let's take a closer look inside of the lower time frames. We'll drop down to a 15-minute time frame next.
So the higher time frame analysis is pretty much the same as the last lecture. If you remember from the last lecture, he mentioned how it would be problematic if we come back down to this gap. Well, price did come back to it, but it only wicked into it on one day and then started rallying. We didn't lay down a body and then start consolidating. So he's taking this as a bullish sign. And now that we're above these down candles, we should not go back down below this low. Now in the last few market outlooks I did mention a retracement below this low and back into this gap, but that was before I realized we're in a premium. From the last lecture, I went over how we should not be expecting price to retrace at a premium if the market is going to continue being bullish. Now, one last point I want to make before we move on, and a little bit of a spoiler on price action for the next few weeks, so skip ahead like 15 seconds if you don't want to hear it. So, spoilers. On the continuous contract, price did make new all-time highs. However, the minis and the micros did not put in a new high just yet. Now here's my question. ICT mentioned using the continuous contract because on the quarterly contracts, price gets spotty if you go back more than say 6 months or so. Now with the discrepancy between these making new highs and not, is this significant in some way? Can we view this as some form of SMT divergence on the highs? Or is it like a six sister effect where the minis and the micros are just lagging behind and we can look for them to make new highs in the near future? I don't know the answer. I wish ICT will give us more of his thoughts on this topic. If you can help me out, please tweet to him with this question or point him to my video in hopes of him responding with another lecture or something, because I do find this quite interesting.
Here we are on the 15-minute time frame. You can see the relative equal highs here. So I went over this in the X analysis video clips and whatnot and posts. So if you see these relative equal highs here, that was a upside objective. And then ultimately, if it gets above that, we would see it run up into that daily fair value gap that you can see the shade up in here. Lower quadrant slammed by the bodies. Look at that. That's absolutely beautiful. And then we have a break lower. What we do today and Friday is really of no consequence to me because I could care less. I have things I have to take care of in my personal life. So this will be the last discussion I have over price action. So I want to take a look at this with you. And this is a 15-minute CIBI, what you can see over here. This should be anchored like that. So body to wick, dropping down in here. Quadrant, consequent encroachment in green. So since it was a CIBI, it's going to change its character to that of something bullish. I said about sell side efficiency, that's just below this 15-minute inversion fair value gap. We consolidate, rally up. I broke this down in here with these two wicks on X, and it was just perfectly delivered as a long entry, trading up into the 21,562.25 level, that relative equal high. And then the market breaks lower all the way down to the low of the 15-minute inversion fair value gap, but specifically to the consequent encroachment of this candlestick right here. So the mohawk, the little coloring outside the lines that we allow for with the wicks because they can do damage, the bodies tell the narrative. Bodies respecting the lower quadrant. We wick down, touch the consequent encroachment or midpoint of this buy side of sell side efficiency. Always includes your volume imbalance or the higher body. That'll be a more specific topic that we'll cover in the book. The drop down in here is FOMC, and then we rip higher, trading aggressively into this run right here is NVIDIA related. So the market trades up into the lower quadrant of that daily fair value gap there.
All right, so basically a quick analysis from him. You can see how he's using the fair value gaps on the lower time frames and aligning them with the bias on the higher time frame. So when we see this reversal trading above these down candles, you should realize that this move here was a trap, a stop hunt, and you can be confident in price not wanting to come back down here. Or if it does, at most, this low should not be taken out, and we are looking for that daily CIBI to be reached. Now, even if you got in here, there is quite some risk, but as you can see, the reward far outweighs the risk. And remember, at a premium, bullish price should not be retracing. So you don't see much retracement here in this rally. Price is pretty much just running for the finish line. So that's it for this one. I hope you got something out of it. If you did, please smash that subscribe button, like this video, and until next time, safe trading.